If you invest in stocks, bonds, mutual funds, and ETFs, do you ever feel like Wall Street has the advantage? Ever wonder how you can protect yourself against the inevitable market downturns without sacrificing returns? Well, we want to let you in on a big secret that market insiders have kept to themselves. We'll give you a chance to invest in the same alternative asset class that Warren Buffett, BlackRock, hedge funds, university endowments, and other institutions buy for their own accounts. Historically delivering fixed amount, above-market returns without the stock market volatility, this investment opportunity can take away all those sleepless nights worrying about money. Welcome to California Life Settlements, where you can enter the unique and profitable world of fractional life settlement investing. But what exactly is a life settlement? A life settlement transaction begins when an insured, typically age 65 and over, decides that their insurance coverage no longer suits their needs. The life settlement market has emerged because many seniors seek to monetize an asset that has become too burdensome on their budgets, or the reasons for which the policy was originally purchased have changed over time. The purchaser, historically a large institutional investor like Warren Buffett or AIG, pays the insured individual a lump sum and assumes responsibility for the premium payments until the policy matures. The insured passes. The life settlement purchaser becomes the contractual beneficiary of the death benefit upon the passing of the insured. The payment of the death benefit comes from some of the most stable financial institutions in America, U.S. legal reserve life insurance companies. Let's look at an example of a life settlement transaction. An institutional investor would purchase a policy with a $5 million death benefit, face amount, from an insured for a bid of $1.1 million. The investor might set aside reserves of $2 million for the premiums, for a total cost of $3.1 million. When the policy matures, the investor receives the $5 million death benefit, returning a $1.9 million profit to the investor. That's a profit margin of over 60%. Of course, if the insured dies before the reserve runs out, the holding period is higher. But if the reserve is exhausted and the purchaser has to pay more in premiums, the holding period return is lower. Because of the high cost of entry, only institutional investors have enjoyed such high profit margins. But not anymore. Just think about it. Could you personally invest $3 million right now? Probably not you, the individual investor. Now there is a way you can participate in this exclusive asset class. How? By investing in fractional life settlements offered through California Life Settlements. We purchase the policy and fractionalize the death benefit payable under the policy. We divide up the death benefit so multiple investors can get a slice of the pie. You don't have to worry about stock markets, bond markets, global markets, or any markets. Even recessions or global pandemics barely affect it. Those sleepless nights are gone. Because your payout comes from the country's most financially stable insurance companies, the program is designed to protect your principal and your dollar return. Your slice of the death benefit is fixed. When you invest, your contract states exactly how much you get paid upon the maturity of the policy, the death of the insured. There's no doubt you have more questions, and we have the answers. Call the advisor who sent you this video, or you can visit us on the web at www.califesettlements.com. For additional information and to obtain a copy of the private placement memorandum, please contact your trusted advisor or email us at agentsupport@califesettlements.com.